Hello, everyone. So, got some exciting stuff to talk about today. I do want to talk a little bit about kind of the format. So, a little bit, I'll talk a little bit about this case in here in just a second and kind of the background behind it. But you may notice that there's a loose alignment between the stuff that we're covering right now and the things that we're covering in the CPA exam. That used to not be the case in my course. I had kind of just random things talked about, the professional and technical cases. I basically did those when I wanted to do those, and they didn't align with CPA prep. And I'm trying to be more conscientious about trying doing things. That's kind of the reason why we're doing this case today, but we'll talk about that in just a second. We are going to continue working on kind of the specialized cases. I believe we've got our controls case next week, and then after that, we're going to be doing a data visualization case. So those of you who were wondering when you're ever going to use Tableau, yeah, there we go. Yeah, so actually, it's going to be kind of a choose your own technology tool item. I'm going to use some stuff in Tableau. There'll be some Excel stuff. I'm also probably going to try to do it a little bit in Power BI. I confess my skills in Power BI are pretty pathetic. So I'm only going to do very basic stuff, but I've already done the work in Tableau and published on Tableau Public, so I'll probably refer to that. We are going to do an AI assignment at the right before spring break, which is more of a fun assignment more than anything. If anything in auditing could be called fun, I guess. But that's going to be our reference. And then we're going to start doing some specific example cases after spring break. Enron will probably be our first one. FTX will be our last one. I haven't decided the ones in between. I may not specifically stay with ones that are really well known and really well documented, but I pick a few out that I think are going to be relevant. We do have another kind of technical case that we're going to do once we get to the attestation stuff in the CPA prep. We're going to be talking about attestation standards. That case is really boring, but I think it's very, very useful as well. So we'll get to more of that later on. So most of our technical stuff we're trying to get out of the way in advance, and then we'll do the fun stuff a little bit later. And trust me when I say, and when it's fun, I've got a special sweatshirt that I'm going to wear just for that day that we talk about it. And what I've been told it's very difficult to concentrate on the content because everybody's just laughs when they look at me like wearing that sweatshirt. So be prepared. It may be hot that day too, because I'm used to wearing it like January when I've done in the past, and it's probably going to be like March. So hoping for a cool day when I can actually tolerate wearing an Enron sweatshirt. All right, so today I've already alluded to this, but this is a case that I've done. This is actually my case. This is a case that I published with my co-author, Catherine Inget. She's working at Augustana right now, and then she's kind of my colleague that I worked on a number of different cases. And then Mitchell Heber, who's a former grad student, who graduated, I believe, it was 2003, so 3 years gone, which doesn't seem like that long ago, but everybody's like, 2003, Dr. Barnes, I was just starting the program back then. Quick, reminding me that you're young. But the idea behind this case is that I was really unsatisfied with the way that audit risk is characterized in all of kind of the educational literature. So audit risk is this conceptual item, and it's like, how does this apply to real audits? And the context that I got talking to managers and talking to partners who are in practice, and that's not something they need to worry about right now. They'll worry about it when they get to a manager or partner level. So first of all, that was really unsatisfying to me simply because you still talk about really, really big picture stuff, even if it's not something that you're going to be practically working on. Secondly, that statement was probably true 4 or 5 years ago. Nowadays, when we talk about what your role is going to be as associates and moving on to senior associates, you're going to be making a lot more critical thinking decisions. And so I wanted to put something together that wasn't necessarily practically relevant, but conceptually relevant. And what this means is this activity that we're going to be working through today, you'll probably not emulate this activity, at least not to the same degree that we're going to be working through. You will definitely not be doing it when you start out. But it is important to start thinking about how does audit risk relate to the things that you're going to be doing as part of an audit. And so that was the goal here. I struggled to get this published because I was trying to do this in a couple different teaching sources, and I always got the same comments: this is not something that people do in audit. And so I'm going to go ahead and throw the disclaimer out there. If you think this activity that we're doing today is something you expect to do in audit, probably not, okay? That being said, I do not think it's a useless task. I do think it's important for thinking about how risk is characterized and how we should think about risk from the bigger picture perspective, particularly as it relates to client validity of information. And so this The reason that this talks about Wirecard is this actually was the capstone paper that Mitchell wrote back in his 2022 class. Now, for a little bit of background, we've reorganized the capstone class, but when I first started here, the way the capstone course worked is that every single student selected one of the accounting faculty members, and they worked closely with those accounting faculty members to actually develop a research topic. And it was both a blessing and a curse. It was a blessing because I got to work with some very, very bright students who wrote some very good papers. And that was usually more the rule rather than the exception. The exception was when students kind of phoned it in. And that did happen occasionally, but that's just large enough population, you're going to get something that happens that way. It was a curse in the fact that it added to our workload substantially, because basically we were expected over spring break to do detailed reviews of all the papers. And when we had really, really large program back in 2018, 2019, all the faculty members were assigned like 6, 7 papers. And so imagine your spring break is basically, okay, I'm going to review a 20-page paper today. And then the next day of spring break, so I'm going to review a 20-page paper today. Yeah, it got really, really arduous. And see, think about me. I'm very lazy. Okay, you all know that I'm extremely lazy, and so I did a assiduous and astute work, but for my level. Okay, imagine Dr. Otero doing that. It's just like I gotta imagine she did not sleep during the entirety of spring break. It just basically like was sun up, sun down, reviewing a paper and putting infinite comments in there. And so that's kind of where I imagine it was. So this is kind of one of those last ones where we worked close with the students, and so was actually may have been past that, but I still worked pretty closely with Mitchell on this paper, and I was really impressed with it. So this is kind of the evolution of that. Is how do we actually characterize this as something that's publishable? Because that's what we're going for research. So as you read through this and tell me or learn a little bit about sparked intuition power, which they're an energy provider, and this is obviously not the same as Wirecard because Wirecard is not an energy provider. This is actually the motivation for this, I guess the model for this was Enron, and so this was kind of the idea is we wanted to do something that was Enron, a little bit lower risk, okay, but moving into energy markets, and then talking about some of the things that you're going to have to consider as part of this new client. What are some of the risks that you have to consider? I also wanted to talk a little bit about audit, or do a little bit of research about audit failures at Wirecard and understanding what the Wirecard fraud related to. This is directly relevant to one of the things that we're going to talk about with respect to risk. But Wirecard itself is a fascinating case study. There were a lot of different resources you can do. I didn't say you had to stick to one, but just wanted to get understanding of that. So let's go ahead and let's dive into the questions. And then I actually have some additional tasks that we're going to complete today once we get through the questions. So first of all, to start out, what are the 4 components of the audit risk model? Now, hopefully when I asked this question, everybody was pretty much like, I remember this from 417. I remember this from the review session. I didn't have to look this up at all. Everybody was like that, right? You can define that well. Nod your heads. Do not shake your heads at me, okay? All right. This is really, really important, but let's go ahead and work this out. So, Troy, give me the 4 components of the audit risk model.
Risk of material misstatement, inherent risk, control risk, and detection risk.
So close, okay. So you have all the components. The one that this probably goes without saying is audit risk, okay. Audit risk component. Now, risk and material misstatement. Risk and material misstatement is part of the audit risk model, but keep in mind when we talk about risk and material misstatement, that is inherent risk and control risk combined, okay. So how do we characterize audit risk? What is a way that we characterize audit risk? Audit risk is basically we say everything is fine when there's a problem. That's the easy way to think about audit risk. And I'm going to kind of shorthand these. Now, I know that there's a definition which actually break down the risk or these risks. I think it's in the appendices. Yeah, the appendices, appendix information. Yeah. You can actually break down the audit risk. So audit risk, which is material statement, section risk, and risk and material statement is inherent risk, control risk. So let's go ahead and make sure we have good definitions of these, simply because these are really important to understand. So audit risk is kind of the defining factor. We do not want to issue clean opinion on financial statements when financial statements are materially misstated. Now, I know that I'm going to sound like a broken record because you've heard me say this many times before, but with scientific testing, there's something called type 1 error and type 2 error. Does everybody kindly vaguely remember that from your science classes? It's like, it's been like 4 years since I took chemistry, Dr. Barnes, or physics or whatever science class you took. So the difference between type 1 error and type 2 error. Type 1 error is when you say there is a problem when there's no problem. say something failed when in fact it actually succeeded. Type 2 error is saying that there is no problem, everything is fine, when in fact there's a problem. Now, are both of those concerns in an audit? The answer is yes, loosely yes, all right. But we're far, far more concerned with saying everything is fine when there's a problem. That's why we're very focused on audit risk. Audit risk is a type 2 error. I'm not saying that you should go into an audit and just start pointing things out and say, that's wrong, everything's wrong. Adverse opinion, okay? That's not the goal here, okay? You do want to be cautious, but the goal is to actually give an adequate opinion, the correct opinion, and we are very, very concerned about saying that there is an issue or there's no issue when in fact an issue exists. Then we have inherent risk, okay? Inherent risk basically says you go into business, then you're exposed to risk. That's all there is to it, all right? But we know that the risk exists, and we know the proper response to risks are called what? My favorite thing in the world. Controls, yes, controls. Do I use that too much? Do I say my favorite thing in the world? Because I also use that for segregation of duties. It's like, yeah, so I don't know. You probably say, Dr. Barnes, your favorite thing in the world is cheeseburgers. And that's an accurate statement, okay? That's an accurate statement. But yeah, I tell a lot of favorite things in the world. So controls. Now, controls are responses to those inherent risks, and we hope that the controls are going to be effective. That being said, controls can fail in a number of ways. They can actually be a failure in the design of controls. So they're not designed properly or not even designed at all. Or they can be designed properly, but they don't operate effectively. That's when somebody basically says, you know what, I'm going to ignore this control because I don't think it's worthwhile. I don't think it's relevant. So that was what we call it, characterized control risk. And as Troy alluded to, risk and material misstatement is the combination of these two. Now, what's unique about risk and material misstatement with respect to an audit? How much control does an auditor have over risk and material misstatement? On a scale of 1 to 10, how much control does an auditor have? 10 being the most control, 1 being zero control. Or actually, 0 would be zero control. There we go. Yeah. It'd be 0 or 1, depending on the framework you use. Okay. Yeah. Auditor has no control over risk and material statement. This is just an assessment. All right. Now, this is important to note because this will come up with respect to your preparation for the CPA exams and questions you may encounter. If you see a question where it says the auditor is going to change inherent risk, or the auditor is going to change control risk, you can automatically discount that question. The auditor does not influence the level of inherent risk or control risk. They can evaluate and assess those items, but they cannot change those items. There is no way for them to manipulate those figures. Once they say control risk is a 5, that's basically where it's at. Now you can reevaluate your assessment. You can say my preliminary assessment is a 5. I've done some testing. Now I think it's at a 7 because I'm going to revise my assessment. But can you change actual control risk? Can you change actual inherent risk? The answer is no. All right, that's important to characterize. Now, then we have detection risk. Now, detection risk is all in the control of the auditors. Now, detection risk is saying any risk that remains after planned audit procedures. Now, does everybody remember the weird thing about detection risk back from 417? So remember we said detection risk, I said be very, very careful about detection risk because it doesn't operate the way you think it does. And the reason I'm so emphatic about that is I didn't understand detection risk my first auditing course, my undergraduate auditing course. I loved my undergraduate auditing professor. He was a great guy, but he taught in a way that was so completely foreign to me. He was very much here's a list of items, memorize these items, and then I'm going to test you on them. That's not the way that my mind operates. And so that's my story is like I got to be in my first auditing class because basically I didn't realize that I had to memorize everything. And then I did that for the second exam, did really, really well. But the first exam, it was like, okay, this is lists. I've got to replicate this. It's not something I do. But he did not really do a very thorough job of explaining detection risk. So how does detection risk work? If I say detection risk is low, is that a good thing or a bad thing? So you're going to want to say, well, risk is low and Dr. Barnes is going to give me a trap. That it's probably a bad thing. And you're right, okay? Detection risk being low is saying we have a low tolerance for risk, okay? Now, if I say you have a low tolerance for risk, are you going to be more sensitive to risk or less sensitive to risk? You're going to be more sensitive to risk. So you're probably going to incorporate more testing, more work, more details. On the other hand, if I say I have high detection risk, what does that mean? It means I have a high tolerance for risk. I am less sensitive to risk. I don't have to do nearly as much work. So detection risk is a bit of a misnomer because it's not actual risk, but it's basically what the auditor's tolerance to risk is. And if we say it's high, then it's less work. If we say it's low, it's more work. It's going to detail the scope of our testing. So that's how we characterize the audit risk model. And just to review, Again, I really think it's important to understand those components of a risk and material misstatement because those are going to be questions that you've asked. The most important thing to remember is risk and material misstatement is completely outside of the control of the auditor. We have no influence over that. We can assess it, but we can't actually change it. All right. So what's a practical example of each component? Let's just go ahead and talk a little bit about each of these. Okay, so these are questions that you may remember these from the practice exam in 417. Okay, so audit risk. Okay, so the audit team for our audit engagement team for Go Corporation was not able to obtain sufficient appropriate evidence to justify its conclusions. Even so, the auditor issued an unqualified audit opinion. So basically, they failed to do their job properly, and they issued an unqualified opinion when the financial statements were materially misstated. Inherent risk. Culture Technologies operates in an industry that is highly competitive and subject to rapid change. Now we know that one of the things that a group is exposed to, one of the things that an area is exposed to is going to be what is the industry and their environment. That's one of the big factors with respect to inherent risk. Control risk. CAP Corporation has inadequate supervision or review over petty cash transactions. Okay. How many of you answered this one by something with segregation of duties? Good for you. Good for you. Okay. I decided to go with something a little bit different. So, and then finally, detection risk. Audit engagement team for Rosen Incorporated did not incorporate confirmation testing over Rosen's receivables. As a result, the auditor failed to identify a material misstatement in accounts receivable. So they did not do their job properly. As a result, they failed in a particular regard. Now, keep in mind, there is a relationship between audit risk and detection risk. Audit risk is a preliminary assessment, whereas we're going to say detection risk is kind of after everything's been done. They did not do their due work. That being said, it's a little bit of a dividing line as to which one represents which. That's why the CPA exam will not focus so much on which is an audit risk versus which is a detection risk. But we will look at some examples of that over the course of our CPA prep. So that's something that is a little bit of a dividing line. Usually, if we're talking about the opinion being rendered, that is going to be more of an indication of audit risk. So that's an easy way to think about it. All right. It's been said, and mostly by me, that audit failure is a function of inadequate assessment and or response to a client's audit risk. How many people agree with that assessment? This is not a group question. This is an assessment question. I'm assuming if you don't raise your hand on this one that you disagree with this assessment, okay? So here's the deal. Is that I think Clayton raised his hand for the first one, and then I'm going to give him that one, and everybody's else going to have to give me a justification for the last. Okay, I'm just teasing. Okay, just teasing. All right. Provide an argument in support of the statement. So you had to argue for both. So because Desoy Logoi, oh my gosh, I realized I scrolled down and it's showing names. I apologize. Okay, cyberbullying. All right. So Austin, what's an argument for this statement?
We said that an audit failure is a function of inadequate assessment of response to client risk. Since auditors are required to identify and respond to potential risks from clients, so if they are not properly performing their duties, mistakes can go undetected.
Very good. Okay. So what is the litmus by which we generally construe an audit failure? Like if an audit fails, what generally has to happen? What is the vernacular we use? It's material something. Material misstatement, okay? The material misstatement occurs. This is generally how we construe an audit failure. Now, does a misstatement have to occur for an audit to fail? There are situations where we could actually argue that a failure has occurred, but there's not a material misstatement. For the most part, though, that is what we're mostly concerned about. That is our criteria for an audit failure. All right. Now, did we just characterize the audit risk model in terms of misstatements? Yes, we actually talked about how audit risk relates to misstatement, how the risk of material misstatements intuitively relates to misstatements, and how detection risk can lead to subsequent misstatements. So the audit risk is kind of entirely focused on this idea of audit failure because that's how we characterize audit failures, this idea of risk and material misstatement. So audit failure is subject to the rigor and application of audit risk principles. And so if we do not incorporate proper principles and proper testing, that is when audit failure is most likely to occur. Can we all agree that that's a relatively sensible statement? A lot of people are not willing to agree. So, Dr. Barnes, you've trapped me so many times. I'm never going to nod my head this was not a trap. I was expecting everybody said, yeah, that makes perfect sense. Okay. And so I would argue that in that situation, we could actually make an argument that audit failure is subject to audit risk, or assessment of audit risk. Now, obviously, I want you to argue the other point because I want you to think about both sides of it. So here's the more challenging question. And Joe, you're up to the challenge?
Yeah.
All right. What's an argument against this?
What we said is a client may mislead the auditor either intentionally or unintentionally to conceal the misstatement and allow the auditor to believe certain information. is or is not true may direct them towards client management to alter the account for specific aspects of their operations. And clients may agree additionally, but opt to not make the change.
Yeah. So clients are contentious and they're really, really problematic. Okay. So it's all the client's fault, basically. We should probably just not take on any clients if that's the case. That's the way we mitigate our risk. Is that the argument that we're making? No, I agree with that statement. I think that's a really, really straightforward statement. And it's important to note that we do have to be aware of the possibility that clients are trying to disguise and deceive us. I do want to think about this at a more basic level, and it does relate to something that Joe said. But is it possible that we could do everything properly? And this includes the risk of fraud, because remember, auditors have responsibility for direct and material, for direct and material impact of illegal acts. So frauds, we have to design procedures that can detect frauds that have a direct and material effect on the financial statements. So is it possible that absent any fraud, a material misstatement could still occur even though the auditor did their job properly? Okay. What is that called? What is that concept called? The auditor can do everything that they were supposed to do and still have an audit failure. So remember, one of the things that's a component of the audit report is this idea of reasonable assurance. Okay. What does reasonable assurance imply? It implies that there's no such thing as absolute assurance. Now, why don't we perform absolute assurance as auditors? Wouldn't that just be a much more resounding result? So let's say you need absolute assurance that you're going to score 15 out of 15 on all the quizzes moving forward. Okay. What are some ways you can do that? First of all, you can hack my account. Okay. All right. That's one way. Don't do that. Okay. But you can also study from now until the end of time to make sure that you have full of it. But yeah, so absolute assurance is what? Not possible. Okay. Not feasible. So we are going to adopt reasonable assurance. Now, it depends on the scope of the audit and the risks that we assign, but generally it's going to be somewhere between 90 to 99% certain. Is 90 or even 99% 100%? They're materially close, but they are not, or it's reasonably close, but they are not equal to that. So even if we do a fully thorough job, we can miss a material misstatement. Now, keep in mind that does not shield us from the consequences of a material misstatement taking place. Material misstatement occurs, that's still going to be something that we're liable for as auditors. But practically speaking, it doesn't make sense for us to say we're going to guarantee that no material misstatements occur. That's just not possible. So an audit failure can occur because of multiple reasons. One, the client is acting in bad faith against us, or two, it just happens just as by virtue of the fact that it happens. Okay. Certainly there's possibilities there. So we've come to a conclusion that audit failure is both a function of audit risk and not a function of audit risk. Okay. It's a little bit like everything else in this course. It just depends. All right. It just depends. All right. Now consider the audit failure wirecard. This is a specific example. Does the event support the notion that audit failure is a function of auditor assessment or response to client risk? Why or why not? Hannah, what did you and your group think?
We said yes, because Wirecard had clear risks such as complex operations, reliance on third parties, and allegations of frauds. And the auditors didn't respond with enough professional skepticism, such as independently verifying the large cash balances.
Yes, so that's a really, really big one. We're talking about that in just a second because that might come up again. So definitely there were some problems in the Wirecard fraud. Now, I do want to make a note of this. After the fact thinking is one thing that we are very guilty of when it comes to educational assessments. We look at these fraud cases and we're just shaking our head like, why didn't they know? And sometimes that's a legitimate question, okay? But when you're in the muck of the details, sometimes it doesn't become very obvious about what details you should not be looking for. These are cherry-picked examples of situations. Now, do I think EY was negligent? Absolutely, okay? This was kind of a pervasive fraud scheme that should have been picked up. And they basically did not do their due diligence with respect to those cash confirmations. Those confirmations were really problematic, okay? So what was going on with the confirmations is basically they had these massive confirmations that they needed to be performing, and they should have been doing them independently. Now, remember, we learned about this back in 417. When you're an auditor doing confirmations, how involved can the client be in this confirmations? Theoretically, or practically speaking, they should not, theoretically and practically are opposites. I don't know where I was going with that. Practically speaking, they should not be involved at all. All right. Why? Because if the client's involved, they can manipulate the information. Now, we may argue it's not going to be feasible for us to be able to do these confirmations on their own. We should try to make every effort to do it if possible. But that's maybe an argument they made. And I think that was the argument that Wirecard made, is that we do not have the context, so we're going to rely on the client. We realize this is going to be a lower level of assurance, but that's the only thing that we can realistically do. And what happened? Wirecard completely and totally falsified the cash balances. They were completely and totally phony. So this is an example of why confirmations have to be done independently by the auditor themselves. So that's something that I think we can argue that if we do not take audit risk seriously enough, we do lead to audit failure. So I think this is support 4. If I were to look at 100 examples in this class, okay, now I don't have 100 examples for you, but let's just assume that I had 100 examples. And I say, evaluate each one of these and say, is an argument for or against our argument? Which direction do you think we would heavily lean? I think we'd lean heavily for. Okay, I think all of the fraud examples, all the big examples that we look at would be auditor did not do their due diligence, they did not do their job properly. The client may have been trying to kind of deceive and mislead them, but it's something the auditor should have picked up just basically through the application of good sound audit strategy and procedures. So I think it would lead heavily that way. I would say probably 90 to 10 or maybe even more than that. That would be the example we're looking at. So yeah, now let's go ahead and do some digging down. Okay, so I just want to do a few of these because believe it or not, I've got something that I'm going to share with you. But I want you to refer to the case in appendices for spark intuition power, and I want you to prepare a list of risks to SIP. Now, in the past, when we've done this over a short period, and usually students are going to be very good at identifying 2 or 3. Which is why I had you identify at least 8, okay? Did you all find that a challenge? Well, if you didn't find that a challenge, good job, okay? If you didn't find that challenge, like, yeah, there are a whole lot of risks there. And actually, the ones that we identified, it's not a comprehensive list. The ones that we identified as part of the case procedures, there was 10, okay? So let's just talk about a few of these that we think are kind of some significant ones we identify. So I'm going to ask each of the groups again, just give me one, and then we're going to talk a little bit about some more in detail. So, Troy, what was one that your group identified?
So there were inconsistencies in their accounting systems and their technological capabilities across their different offices.
Yeah, so definitely, generally, their AIS is certainly problematic. Their information system and the procedures they incorporate. That's something that I think we can agree on. This is listed. I'm not sure if that's in our whole list, but it was something that we definitely put in there intentionally to as an identification. So, problems with the information system, certainly problematic. Okay. Austin, what did your group say? Okay, what do we call that from the fraud risk perspective? 3 parts of the fraud triangle, which one of those? Pressure, guys, it's pressure. It's pressure. Like Bowie and Queen, under pressure. Does anybody even know that song anymore? Okay, good, okay. Can't forget the classics, guys. All right. They're under pressure. Their compensation is tied to their performance. So certainly something we have to consider. What's another one? Joe.
Their high revenue and profit in their solar buyback program when everybody was not making anything off of it.
Interesting. Okay, so it's something we're going to have to deal with and drill down a little bit more. What's one more, Hannah?
The bank confirmations are coming from the client, not from the bank.
Oh, it's like we talked about that deliberately or something like that. Yeah, good identification of low-hanging fruit, but that is definitely one I wanted to pick up on. All right. So it's important to note that identification of risk is really, really important, but that's not the only thing we have to do. We have to figure out how do these risks permeate throughout the audit? How do these risks identify? So identification risk is one factor, but we have to note if we're going to address these risks, we need to know what our responsibility is. And that assessment comes into 2 parts. First of all, we've got to assess what is with the respective level of risk, and then how do we allocate enough work time to be able to do that? So that's going to be the second part of this activity. So you will notice I walked in with some pieces of paper. There are 14, which you probably can figure out there's 14 people in the classroom. So what I'd like you to do over the next 10 minutes or so is that there's a list of 10 risks. And again, these may or not align to the risks that you identified, but you're going to do a couple of things, okay? The first thing you're going to do is you're going to assess, based on the risk listed, is this going to be a risk that you would characterize as low, medium, or high? All right. Now you may say, let's just go with the easy way, Dr. Barnes. We're going to characterize everything as high, and that way we test everything. Is that a valid strategy? Not realistically, because auditors are subject to time constraints. And if you said everything is high, that means that you're going to have to spend a lot of time on everything. So I've given you a work constraint. Basically, if you characterize something as low, you have to work for 2 hours. If you characterize something as medium, you have to moderate, you have to work for 3 hours. If you characterize it as high, you have to work for 4 hours. There are 10 risks. If you characterize everything as high, you would be working for 40 hours. Guess what your budget is? 35 hours, okay? So if you characterize everything as high, you break your budget. Now, is that a feasible strategy? Could you go to the partner and says, well, I thought everything was high legitimately. The partner said you're fired. They won't say that, but they'll say, yeah, I'm not going to approve this. They're not going to approve this. So we're going to see if we can work this out, and we're going to see if we can adapt strategy. Now, there are, like I said, there's 10 items. Basically, the way that you work this out is you're going to be using a budget of 35 hours, and I'm going to hold you to that budget. Is it possible to go under budget? The answer is yes, okay? I think we could actually do this in 29 hours. That being said, are there costs to inaccurately assigning risks? So say that you assign something as a medium risk when in fact it's a high risk. What are the implications of that for the audit? A much higher chance of misstatement in that particular area. So you're going to be subject to a challenge here. You're going to have to assign risks, but you can't improperly assign a risk too low, okay? If you think something is a higher risk, you need to assign that to a higher level, simply because if you assign it at a low level, then that's going to increase the risk of misstatement later on. So that's going to be your challenge here. I'm going to let you guys work on that, see if you do that. Now, yes.
This is based on sparked intuition power.
Yes.
Okay.
Okay. I do want to make a note here that do not fret too much about this. Do not think too much overly about this. There's no penalty. There's no grading assignment associated with this. This is just mostly a thought piece activity. I will guarantee that your answers are not going to match my answers. Okay. But the goal here is not to make sure that everything lines perfectly. The goal here is to see if we can actually critically evaluate how we should approach a task like this. So let's see if we can do that. All right, so people are done. How confident are we in our answers? Scale of 1 to 10, or 0 to 10, I guess we could say. 5, okay, all right. I don't know, I don't really trust a lot of people named Ben H anymore. Independent reasons, so we don't know. Anyway, that joke's never gonna get old. All right. So let's go ahead and characterize some things real quick. So if you recall from the appendices, there were actually some debriefs on what would represent low risk, moderate risk, and high risk. Okay, so low risk is pretty straightforward. It involves questions, but not major concerns about material misstatements. Moderate risks they are less transparent, but they generally fall below material misstatement thresholds and less significant than a transparent issue, or more significant than a transparent issue. Excuse me. And then high risk generally or potentially lead to material misstatements. They breach accounting standards and must be investigated thoroughly. Something that's probably not included in here, but probably should have been included, and this is retrospect. When we talk about high risk, this is something that is going to be again, either a deliberate breach of accounting standards or pervasive of the financial statements, or we could actually say this is something that makes it's a deliberate deception or misrepresentation of the correct position. And I think that actually is an important caveat to make, because some of these you could actually characterize as either moderate or high, depending on your interpretation. These first few are very, very challenging. All right, I think 3 out of the first 4 are going to be arguments for one of 2 different directions. So again, if you came up with the same answers I did, great. If you didn't, actually, if you came up with the same answers I did, why are you copying my teaching notes? But if you came up with the same answers, that's fine. If you came up with a different answer, that's fine too. But I do want to talk about some of the intuition we could use here. So exceeding expectations for the past 16 quarters. Now, if you look back to the notes of the external auditors, it's basically rare for earnings expectations to be exceeded for 4 straight years. And it's also important to note that 5 years ago is when they instituted the solar buyback program. So can we characterize this as at least a issue with the transparency and risk? Now, does this involve a deliberate misrepresentation of position, do you think? This is kind of the key to interpreting this particular situation. If you think this is a deliberate misinterpretation, then you may say this is a high risk. And I think there's arguments for that. My characterization of this, or at least my co-authors and my characterization, was a moderate risk for this one, okay? So if you were high on this one, then that's fine. I think you can make an argument for that. I think moderate makes more sense. I don't think low could actually be feasibly argued here. As Troy alluded to, SIP offices have outdated technology and some are still on paper-based systems. There's probably some accuracy with reporting issues because if you're on a paper-based system, it's going to be really hard to manage a $17.6 billion company. Okay. So this one's another challenging one. I do not think there's deliberate misrepresentation. I also think that the role of the auditor will play a key factor in here, especially if they've been audited in previous periods, then we can actually know that they're probably going to be a lot closer to accurate than inaccurate because, again, the goal of the auditor is going to be make sure that there's no material misstatement. So again, this is one that you can make an argument between either moderate or high. We made the argument for moderate. If you said high, again, it's not a big problem. I think there's reasonable arguments for both. This next one's a little bit more straightforward, I think. This is one I think is there's not really a lot of wiggle room on this one. So accounting procedures remain the same for the past few years. So there's been a lot of change in accounting and regulation. So you can make an argument, say this could be a significant risk because there should be changes. But is it necessary that accounting changes in a 15-year period dramatically? I would say oil and gas accounting procedures have remained the same over the past 3 decades. All right. So even though the technology changes, the procedures themselves are pretty underlying. So I do think this represents a risk, but I do not think it's significant risk. And I think it's hard to argue that. So I would say moderate on this one as well. By the way, they're not all moderates, just for the first few. Okay. Solar buyback program has annual revenues of $950 million. So usually new businesses take a number of years to regenerate. Now keep in mind, this is going to be a little bit separate from a later risk where they're going to be talking about the recognition of advanced revenue. So the one here. Annual revenues themselves, I don't think represent innately a risk. So we characterize this as moderate. That being said, you did need to actually make sure you clarified that this is different than their revenue recognition process, because that's going to be a big deal, which is a spoiler for number 5. Advanced revenue recognition system. It is not in accordance with GAAP, and they're recognizing the full amount of first year revenue immediately. Okay. So what other company did this that we know about? Enron. This is something Enron did, which this is kind of motivated by Enron. We can say anything to do with Enron is high risk. Okay, that's just nature. Say this is going to definitely be a high risk. Again, separation in 2 items here. We need to talk about separation of users of a small bank, and then they can't complete online confirmations. These are related, but they're not necessarily the same risk. So the use of a small bank for the buyback program, that's going to be a moderate risk because there's not really deliberate misrepresentation. But we know that there's a risk of deliberate misrepresentation in number 7. They can't complete online confirmations, so they had to rely on the SIP for the bank information. That's actually a direct reference to the wire card. That's a higher risk. All right. Moving on to 8, the CFO and COO stepped down in recent years. How long ago was it when they stepped down? Did anybody remember that? 7 years ago. Do we think 7 years is still enough of a threshold to have an impact? Probably not. This is going to be a low risk. Okay. Is there still some significant effect or some relevant effect? Yes. It's probably not a material or transparent effect. SIP utilizes performance-based compensation for executives. We know this to be a pressure. This is one of the aspects of the broad triangle. How well documented are executive compensation based on performance? How does that have to be disclosed in the financial statements? Yes, it has to be thoroughly disclosed in the financial statements. If you're an auditor and you see thorough disclosure of this performance bonus, do you think it's a risk? Yes. Do you think it's a significant risk? Probably not. Okay. So we're going to say low on that one. And then the solar buyback program was implemented by the COO and CFO. Again, this is not referring specifically to the reporting for the solar buyback program. The revenue recognition is certainly a problem with the buyback program. A new program itself. Is it common for new executives to come in and shake things up to try to change the environment they're operating in? So would we be surprised if that happens in an organization? Probably not. I think this is another low risk. Okay. So basically the way you assign these is anything that was a high risk, you had to assign 4 hours to, anything moderate 3 hours, anything as low as 2 hours. You could have come up with 29. My guess is that you were more cautious and went closer to 35, and that's perfectly fine. Okay, that was your budget given to. This was one of those things that it was definitely challenging to come up with what was a closer to that answer, closer to the correct answer, or to the answer that we give. I shouldn't say correct answer because, to be honest, in a situation like this, this is a very subjective activity. There are no correct answers. The only thing that you can use is good judgment to be able to rationalize your arguments. All right, we're done for today. We've got CPA prep on Friday. See you all then.